The current value of my long-term dividend growth stock portfolio is $234,594. With $143,279 initial dollars invested, this puts my total return at 63.73%. I built this account primarily over the past 5 years and am down slightly from the all-time high after selling off a bit on Friday. Year to date, the S&P 500 is up 2.1%, but it's been quite the rocky year with it as low as negative 15%. This has created a lot of buying opportunities and a chance to rebalance my account, which I discussed in my latest portfolio update videos. Currently, I own 10 stocks in this portfolio. Today, I'm going to analyze the top 10 stocks I own, sorted by total value. With each, I'll give you my updated investment thesis and a bull and bear case. On top of this, I'll share all my recent buys and dividends coming in. With that said, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Over the past 5 years, I've provided frequent updates of my long-term dividend growth stock portfolio. Just this year, you've watched me grow my account by $35,000, and I started sharing all the way back when it was $30,000. These videos help hold me accountable and clarify my own investing strategy. Hopefully, they can serve as a source of motivation for others as well. If you want to track your portfolio and research dividend stocks just like me, then sign up and become a member of my website, dividenddata.com. I've made a bunch of improvements in recent weeks, most notably around automatic portfolio tracking. I just pushed a big fix for Fidelity users and improved reliability for a wide amount of US brokerages. Also, I just added our starter pack for all members to help you master dividend investing in as little as 7 days. It's available now on the sidebar where it says starter pack. This includes a research report with my entire strategy and lists of curated stock picks so you can get started fast. And that's for lots of different goals, whether you want high yield stocks or high dividend growth, or even ETFs to make investing simple. This exclusively launched with the start of our summer sale, but after many requests, we're rolling it out to all users right now. Speaking of that, our best deal ever to join dividenddata.com is available right now. You can lock in 50% off annual membership and keep that low price for life. There's a 30-day money-back guarantee, so no risk in trying it out. The link is in the description and pinned comment of the video. With that said, let's get to the portfolio update. Everyone's in a different phase of life. I'm currently 26 years old and have a long investment time horizon. It's for that reason that I prioritize long-term dividend growth and total return. I want to invest in high-quality businesses with competitive advantages that will continue growing their dividends year after year. To accomplish this, a company must be able to grow earnings per share and free cash flow. Before I analyze my top 10 dividend stocks, let's head over to look at my projected dividend income and what I've been paid already this month. Plus, I'll share some of my new buys. This portfolio pays me $5,634 in annual dividends. That's $1,400 every quarter, $469 every month, $15.44 every day, and 64 cents every hour. This is passive income that I reinvest to earn even more shares, growing my future dividend income. You can see I have a 3-month cycle in dividend payments depending on what stocks pay in those months, and all of my stocks that I'm going to share today are quarterly dividend payers. My largest month right now is $608.38, and my other two are just around $400. My dividend yield on cost for this portfolio is 3.45%, but from reinvesting dividends over the years, that's boosted up to 3.93%. So based on my initial dollars invested, I'm earning just under a 4% yield. And we'll come back and look at the dividends for my 10 stocks later in the video. So far this June, I've already been paid $356.46 in dividends. Year to date, I've earned $2,518. And I think I'm finally set to actually grow my dividend income a lot in the coming years. And the reason is I've made a ton of adjustments in my account over time. Originally, my portfolio was very unfocused with a huge amount of stocks. And then I learned more and more about investing, and I concentrated in some very high quality stocks that I thought would do well in total return, but some of those had lower dividend yields. So you can see my dividend income actually plateaued for a few years. About a couple years. And I had 1 month in my quarterly cycles that was below $100. However, I have since rebalanced and I have some new positions that I'm excited to share with you today. And that actually helped grow my dividend income, and I think will actually do very well in terms of total return. So this month I got paid $96 from Microsoft, $167 from Exxon Mobil, and $92 from Visa. We'll talk more about this and all these other companies later. Now let's talk about some of my recent stock buys. So far in June, I bought $1,590 worth of stock. That includes 1 share of TPL, that's Texas Pacific Land Corp., and that was at a cost per share of $1,069. I also bought 2 shares of CRM, which is Salesforce. That was at a cost per share of $260.70. These are both low yield stocks, but I think they will do very well in terms of total return. I'll talk about that later. Don't worry, I will be sharing some high yield stocks today as well if you're focused on optimizing your current income. All right, so let's go over my top 10 dividend stocks. Number 1, I have Microsoft, ticker symbol MSFT. I have 116.63 shares, 2.6 of which came from reinvesting dividends. I have $55.3 thousand in total value, with 29.6 thousand initial dollars invested. That gives me a total return of 86.61%, or about 25.7 thousand. The majority of this position was built up in fall 2022, but I have added over many different points, and this is a stock I will continue buying into over time. Although this is my highest value stock, it is not the highest in terms of dividend income. It pays me $387 in annual dividends. My yield on cost is 1.27%, and from reinvesting dividends, that's up to 1.3%. If we head over to the stock analysis tool, you can see the actual business behind the stock, and that's where you can see the earnings and cash flow, which ultimately pays the dividend. Microsoft is a very high-quality big tech company that I think is set to continue growing for decades to come. I added to my position multiple times in 2025 during that tariff sell-off, but that was not one of the larger positions I bought. We'll talk more about those later. As you can see, Microsoft's earnings per share is growing at a high rate over time, and analysts are projecting high future earnings growth as well, over 10% every single year. And that growth is actually expected to accelerate. Microsoft has incredibly reliable high dividend growth. The 10-year compound annual growth rate of the dividend is 10.35%, and they raise it by 10% basically every single year. This is incredibly reliable growth. And the payment's sustainable too. You can see the current free cash flow based payout ratio is 29%, and that's 24% based on net income. Microsoft's payout ratio has actually been going down over the past decade because they have so much earnings and cash flow growth. This company is an absolute fortress of a balance sheet, and the majority of their revenue is high margin and recurring. This allows the company to continue building upon that base and expand year after year after year. The 5-year compound annual growth rate of revenue per share is 15%. Over the past 5 years, Microsoft has a total return of 156%. And since 1990, this is one of the best performing stocks in the stock market with a 124.9 thousand% total return. The bull case for Microsoft is all based around cloud and AI. Their overall cloud business grew by 22% last year, and Microsoft Azure, which is their main growth business, increased by 35%. That's primarily driven by AI. So the bull case is that continues for decades, which I think it will. The bear case for Microsoft, in my opinion, comes more around valuation and the price you're paying, and whether or not the AI growth continues at a high rate. Also, in my opinion, the bear case comes around their large capital expenditures. This is because they're investing so heavily in AI infrastructure and data centers. As you can see in the trailing 12 months, that's now up to $61.3 billion in CapEx. And it's nearly tripled over the past 4 years. And frankly, that's probably going to continue growing to $80 billion and maybe $100 billion in a few years. And that's why Microsoft's free cash flow growth has not been as high as it could have been compared to their earnings per share and revenue growth. They are making a lot more money, but they are also spending more in capital expenditures. So the big question with Microsoft is whether they get a return on their investment. So far, it's looking pretty good. And in my personal opinion, it will be good, but the future is unknown. Stock number 2 is Visa, ticker symbol V. This is another low yield, high total return company. I have 156.57 total shares, 1.5 of which have come from reinvesting dividends. My current total value is $55,200 with $39.2 thousand invested. I'm up $15,960, which is a 40% total return. The majority of this position was purchased in 2023 and 2024. And I have not been buying it so far in 2025 as the valuation has gone up a bit, but there was some news that made the stock sell off 5% on Friday. We'll talk about that in a bit. Again, this is not one of my larger dividend payers. The current annual dividend income is $369. My yield on cost is 0.93%, and from reinvesting dividends, that's up to 0.94%. Visa is an incredibly dominant business. They're considered a duopoly with them and MasterCard. They trade at a high PE multiple, but that's because of their market position and how stellar the economics of their business are. As you can see, their earnings per share has grown a lot over time, and the stock price has largely followed suit. This is a company that analysts are projecting double-digit earnings per share growth in the coming years. Visa has been a dividend growth machine with regular annual increases. The 10-year compound annual growth rate of the dividend is 17.26%. The 5-year CAGR is 14.48%. Their most recent dividend increase was 13.4%. And the payment's very sustainable with a 22% free cash flow payout ratio and 21% based on net income. And now let's talk a little bit about why Visa has such a great business model. They have 80% gross margins, 65% operating margins, and 55% net margins. Visa is also a free cash flow machine. As you can see, their free cash flow per share has grown at a 10-year compound annual growth rate of 15.8%. And if we go and look at the cash flow statement for Visa, I'll tell you why. The 3 columns we're going to pay attention to here are cash from operations, capital expenditures, and free cash flow. Visa benefits from an extremely scalable business model. They are a payment network, so the more transactions they can have on that network, the more they will earn, and that growth can happen with limited capital investment. As you can see, over the past decade, their annual capital expenditures have gone up a little more than 2 times, from $550 million to $1.2 billion. But their cash from operations has grown from 7.2 to 19.95. So their annual free cash flow has tripled in that time. And that's how they're able to continue paying a growing dividend and repurchasing shares every single year. To quote Charlie Munger, Visa is a business that drowns in cash. The only logical thing is to return it to shareholders via dividends and share repurchases. The 5-year total return for Visa stock is 89%. And since going public in 2008, they have a 2,375% total return. Now, there are some things you need to understand about Visa and MasterCard, which just sold off recently. And this kind of ties into the bull and bear case for the stock. The sell-off happened from news that Amazon and Walmart are considering launching their own stablecoins. This was a report from the Wall Street Journal, and these would be stablecoins pegged to the US dollar. And the reason why they would be doing that is to potentially reduce transaction fees associated with credit card networks. But this is not mentioned. It would also apply to banking institutions. For large retailers, transaction fees is a big part of the cost. These are low-margin businesses that do tons in revenue. Now, first, would this actually happen? This was a report that they were, quote, exploring the idea. So there's a chance that they never do anything with it. Frankly, I'm not concerned about this threat, especially before there's any real news or data around it. And I think even if the stablecoin thing happened, I don't think that would really impact the consumer spending side of Visa. And that's from the standpoint that consumers will still have Visa and MasterCard cards that operate on their payment network, and they have such overwhelming market share that these retailers are not going to not accept any of these payment methods. And that's where you get to the value of the network effect of Visa. I also don't think that the stablecoins will be compelling for consumers. For one, consumers like credit cards and the fact that they can pay it later. And they also like the rewards they get, like cash back and points. That is only possible because of the fees and also the credit system at these financial institutions. And Visa has incredibly strong relationships with these financial institutions, whether it's Bank of America or JP Morgan, and they partner with these companies to issue Visa branded cards so that they can then operate on the Visa payment network. But Visa itself doesn't bear the credit risk. That's the financial institutions. However, Visa does pay these financial institutions to issue cards under their brand. That's part of what also funds these large credit card reward programs. So consumers will still have banks that will still have credit cards and will still operate on the Visa and MasterCard payment networks. Visa and MasterCard are also investing a lot to improve their payment networks with blockchain technology. So they aren't standing still in this. A big part of Visa's business is also value-added services for their clients, whether that's financial institutions or retailers. That includes things like fraud prevention. So overall, I view this Visa and MasterCard sell-off as more of a buying opportunity than an actual risk. That said, the company was already trading at its all-time high in stock price and at a higher multiple than usual. So I'm not personally buying the dip on Visa yet. I'm more in the hold category right now. But if this sold off another 10 or 15%, I would consider adding. And if you're interested and don't have a position yet in Visa, this could be an interesting time to start looking. Stock number 3 is the Altria Group, ticker symbol MO. I have 568.69 shares, and 104.69 of those shares comes from dividend reinvestment. My current total value is $34,000 with $19,900 initial dollars invested, giving me a total return of 70.8%. This is my top dividend payer with a total annual income of $2,320. My dividend yield on cost is 9.51%. And from reinvesting dividends, that's up to 11.65%. So this is by far my top dividend payer. It is actually 41% of my annual dividend income. Now, Altria stock is a very different story from Visa and Microsoft. This is a high yield company where a big part of the return comes from dividends and reinvesting dividends. The company also trades at a much lower multiple. The current PE multiple is 10. They also grow their earnings per share, but at a much slower rate. This company has also changed a lot over time with the spinoff of Philip Morris International and Kraft Foods. I've talked about that in prior stock review videos. You should go watch those if you want more information. This is a great high yield dividend stock though. The 10-year compound annual growth rate is 6.9%. The 3-year CAGR is 4.2%. And in my opinion, you should expect 4% dividend growth moving forward. It is sustainable with a free cash flow payout ratio of 79%. And this is a very mature business that is not able to reinvest a lot. So by design, they pay out a lot of their cash flows as dividends. Now, I'm not buying more Altria stock right now because it's actually trading at a relative premium. The dividend yield is now down to 6.8%, which is still very good. But this stock was a steal for a long time, and I was buying a ton during that 9 to 10% range. And I'd probably look at adding to the stock again if it gets into the 8% dividend yields. 6 to 7 is still very strong, but you have to keep in mind that this is a lower growth company. The 5-year total return is 112%. And since 1990, despite being in a declining sector, this stock has a total return of 11,700%. The bull case is that it's just business as usual. Cigarettes are still the cash cow of their business, and the volumes decline year after year, but they raise prices and actually make a little bit more in earnings every year. They also have 2 growth businesses, one with the product Enjoy, which is a vape, and then they also have a presence in nicotine pouches with On nicotine pouches. The bear case for Altria is regulation. If any of their core products got banned, obviously that would be a problem. Stock number 4 is Alphabet, ticker symbol GOOGL. This is the parent company of Google. It is a newer position of mine. I have 156.09 shares. The current total value is $27,000, and I have a 7.83% total return. This has almost entirely been built for me in 2025, and in my opinion, the stock was a steal, and it's still a great value. Alphabet stock pays me $131 in annual dividends. This is a new dividend payer, and they just had their first dividend increase, but I do think over the long term, this will be a dividend growth stock. My dividend yield on cost is 0.52%. I've done a lot of stock reviews on Alphabet in the past, so go and watch my videos if you want a full deep dive into the company. But in short, this is one of the best big tech companies in the world. They are a leader in AI, and they have some core cash cows, most notably in digital advertising with Google Search. They also have some growth businesses in YouTube, and in cloud computing, Google Cloud is the number 3 competitor, and it's a fast-growing business for Alphabet. As you can see, their earnings per share have grown a lot over time, but they can dip whenever advertising markets dip. And it's pretty amazing a high growth company like this trades at a 19 PE ratio. And with expectations of double-digit earnings per share growth annually, based on today's stock price, the 2029 PE ratio is 10.6. That is, of course, if they hit these estimated earnings per share targets. This company generates so much cash flow that they finally started paying a dividend. This is a trend in big tech. Meta also started paying their dividend, and they just had their first dividend increase of 5%. The payout ratio is super low, below 10%. The bull case for Alphabet is that they continue growing at a high rate and their valuation is very attractive. They are also one of the leaders in AI, which could be a huge growth business for them long term, but that's also a bit of a double-edged sword. There is large speculation that Google Search as a business could be in the decline, and that AI could mean that we move away from the blue links. However, I think we have to factor in there's no evidence of decline in Google Search so far. They're actually growing searches every single year, and Google is integrating AI throughout Google Search, and frankly, it's getting very impressive. I also think Alphabet is the best position to leverage and monetize a free AI-based search, considering they have this large digital advertising network, and they also have the largest distribution. Similar to Microsoft, other negatives are their increased CapEx. They are spending a ton in AI data centers, and there is a question about what the return on investment in that is going to be. But in my opinion, they have to do it. Overall, though, I'm planning on this being a core position in my account. I still think it's attractive at these prices, and I'm looking at it right now, and I probably should just put in more buy orders and dollar cost average. I think this stock has a lot to go up over the long term, but that's just my opinion. Do your own research before making any investing decisions. Stock number 5 is Exxon Mobil, ticker symbol XOM. I have 170.8 shares with 32.8 shares from dividend reinvestment. My current total value is $19.1 thousand, and I have a 239% total return. That's a $13,000 gain. This is one of my largest dividend pairs. The annual dividend income is $676. My yield on cost is 9.68%, and from reinvesting dividends, that's up to 11.98%. And I am planning just to hold this and continue reinvesting my dividends for the foreseeable future. I just covered Exxon Mobil stock a few days ago in my top 5 energy stocks video, and it is a great high quality business. Their earnings do fluctuate up and down though over time depending on oil prices. And I'm personally not buying this stock right now. I like to buy these oil stocks when they're in a bust cycle. As an example, I loaded up on Exxon during 2020. Oil prices were low and they even lost money at a certain point. As you can see though, when oil prices are high, this company is incredibly profitable and they have a great balance sheet and are able to weather the storm throughout any economic environment. They've been increasing their dividend payment for decades. The 10-year compound annual growth rate of the dividend is 3%. The 3-year CAGR is 4%. Now you can see the 2 most recent dividend increases were both over 4%. The free cash flow payout ratio in 2024 was 54%, and that was 49% based on net income. The current dividend yield's 3.53%. And honestly, I don't know if I'll really be adding to this stock anytime in the foreseeable future, but I have a great position I will continue holding and reinvesting dividends. If you want more of my thoughts, go watch my recent energy stock video. At the fundamental, the whole story with whether or not to buy Exxon comes down to oil prices, and I like to buy with a large margin of safety. 2020 was a crazy year, and you got such an outlier in dividend yield. Stock number 6 is Salesforce, ticker symbol CRM. This is another total return focused company. I have 68.06 shares. Total value is $17.5 thousand, and I'm actually down 4.88%. This is a newer position of mine as well. I've been buying quite a bit of this during 2025. This is a low yielder for me. It pays me $113 in annual dividends. My dividend yield on cost is 0.61%. Current dividend yield is 0.64%. This has been a very impressive growth stock, and they generate a ton of free cash flow, which is why they started paying a dividend. As you can see, the company's earnings per share have just grown at an insane rate over the past decade, and the stock price has largely followed that path. Analysts are projecting double-digit earnings per share growth in the coming years. The revenue per share chart for Salesforce is lovely. 10-year CAGR is 16.42%, and you can see just the reliable growth year after year. However, people are concerned about slowing revenue growth at Salesforce. Revenue per share only grew 10% last year. That's still pretty good, but it is a slowdown. But if we take a look at Salesforce free cash flow per share, the growth is absurd. The 10-year CAGR is 26.7%, and the 3-year CAGR is 32.69%. This is why the company has started paying a dividend and growing that. They had their first increase, which was 4%, and it's very sustainable with a 12% free cash flow payout ratio. The company has also started repurchasing shares, which is nice. The bull case for Salesforce is that they continue to see high revenue and earnings growth. Also that they're able to acquire more companies and create new AI-focused business features. Then they can use their wide product ecosystem and large customer base to continue expanding. I think that's probably the most likely outcome. As an example, they have Agentforce, which is a new AI product. The company also has a ton of data from their customers. The bear case is that AI creates a lot of competitors for Salesforce, and possibly companies aren't willing to pay as much for Salesforce software, and there could be many more AI native applications that become a threat to Salesforce. I personally think the company has a lot of advantages, and I am more in the bull case for Salesforce. That's why I've been buying the stock and even added to my position over the past month. So this is another company I'm looking to continue building my position in. Stock number 7 is MPLX. This is another company I have been buying in 2025. That's when I started my position, and I wish I knew about it years ago. I have 203.68 shares, and I've already reinvested my first dividend to get me 3.68 more drip shares. My current total value is $10.5 thousand, and I bought this a bunch during the tariff sell-off, and I already have a total return of 11.37%. Despite being a new position and lower down on the list, it's now my number 2 dividend payer with $779 in annual dividends. And the reason is it has a great dividend yield. I have an 8.06% yield on cost, and from reinvesting only 1 dividend so far, that's up to 8.21%. So in terms of dividend, this is going to be a game changer for my portfolio. Now, if you want my full thoughts on this company, I just did a 25-minute stock review where I go deep into the stock. So I will link that below. Please go watch that. In short, this is a midstream oil and gas company. Earnings per share has been growing at a decent rate. Current dividend yield 7.37%, but this is a unique stock with high dividend yield and high dividend growth. The 10-year compound annual growth rate of the dividends 8.84%, and the 3-year CAGR is 10.7%. This is a quarterly payer with annual dividend increases. The most recent dividend increase was 12.5%. So that's actually accelerating dividend growth. And based on free cash flow, this company has a very sustainable payment of 73%, which is healthy for these partnerships. I wish I knew about this company though back in 2020 when I was buying Exxon, because you could have gotten this at a 16% dividend yield. And the 5-year total return is 344%. And I'll give you a short little bull and bear case. These midstream companies are shielded a little bit from the commodity price of oil and gas. They have contracts that are based more on volume. So the bull case is really that natural gas continues growing and crude oil stays the same or slowly grows. And MPLX continues to cash flow very well and make some acquisitions, which I discussed in the stock review video. The bear case, though, would be we go through some kind of prolonged oil and gas crash where they actually cut supply and stop producing as much. I see that as pretty unlikely. And you can see that even during 2020, this company remained highly profitable and was growing their dividends during that time. So MPLX is a stock that I'm looking to add to a lot. And I just put in new buy orders starting from the low $50 range all the way down through the 40s. So hopefully it sells off so I can keep building this position. In a similar vein, stock number 8 I have on my list is Hess Midstream LP, ticker symbol HESM. This is another midstream energy company. I have 108.21 shares with a 3.21 from drip shares. Current total value is 7.4 thousand. I have an 11% total return. And I bought this at the exact same time as MPLX and I'm building up both of these positions. This is already my 4th largest dividend payer with $534 in annual dividends. My yield on cost is 7.89%. And from reinvesting dividends, that's up to 8.03%. If you want to learn more about this, I just did a video on my top energy stocks. I cover HESM in that, and I'm going to do a full independent stock review on this. Earnings growth is good. It's powering great dividend growth. Dividend growth is fantastic. Again, high dividend yield with high dividend growth. Current dividend yield 7%, 10-year CAGR is 10.49%. And this company actually increases it every single payout. So that's a 1 to 2% increase every single dividend. Based on free cash flow and distributable cash flow, the payout ratio is very safe. And again, like MPLX, if I knew about this in 2020, I would have loaded up. And I thought this stock was also a master limited partnership where you got a K1, but they actually restructured a few years ago. So thank you to someone in my comments of the energy stock video who pointed this out. They switched to what's called an Up C Corp. And basically what this means for you is on tax purposes, it will be on your normal 1099 div form, and you don't have a separate K1 form, which is what you would have for MPLX and what I will soon talk about, EPD, that I own. I don't have much of a problem with that, but a lot of people like to avoid the K1 documents. So HESM, you can get it and avoid the K1. Similar to MPLX, I just upped my buy orders on this stock. And from the low $38 range, I have orders in buying it all the way down. Again, this is just my opinion though. Do your own analysis. Stock number 9 is Enterprise Power Partners, ticker symbol EPD. I've owned this one for quite a while. I have 142.1 shares, and I've earned 43.1 shares from dividend reinvestment. My current total value is $4,500, and I have a 131.7% total return. I bought this stock in 2020 and 2021, and really I should not have let these midstream companies slip by. I should have been building these stakes over time and doing more research on different ones. I mean, you learn more and more over time, but I didn't really understand how their business models work. In fact, when I originally did my EPD stock review video, I actually messed up a few things. This was back in like 2021 or whatever. This company pays me $304 in annual dividends. My yield on cost is 10.78%. And from reinvesting dividends, that's up to 15.48%. So this has been a great dividend pair, and it gives you a little bit of context about what reinvesting dividends with these high yielders can do over time. I've increased my yield on initial dollars invested by 4.69%. This one is another great midstream oil and gas company. They're the largest of the 3 I shared today. This one is an MLP where you would get a K1 document. I've had it for many years now. If we look at EPD, they have a long history of dividend growth, and recently they've been increasing it every other quarter. The 10-year compound annual growth rate of the dividend is 3.62%. The 3-year CAGR is 4.79%. So it's still a nice yield plus growth, but I like EPD less because they're growing at a lower rate compared to HESM and MPLX. But I still like this enough that I'm going to continue holding it. The bull and bear case are pretty much the same as the MPLX and HESM. Finally, stock number 5, I have another energy stock, Texas Pacific Land Corporation, ticker symbol TPL. This is my smallest position and it's a new one. I have 3 shares. Total value is $3.3 thousand and I'm down 1.9%. This is also a low yielding energy stock and my lowest dividend payer at $19 in annual dividends. My yield on cost is 0.56%. If you want to learn more about this stock, I just did a 5-minute segment on it in my latest top 5 energy stock video. This will be linked at the end screen, so go watch that if you haven't seen it. I'll be quick with this one. Total return's fantastic. They own a bunch of land that oil and gas is drilled on. It's in the Permian Basin in Texas. And this is a highly profitable royalty-based business. So the margins are incredibly high and their earnings per share have been exploding as they convince more and more people to drill on their land. The dividend's also nuts with this one. They have a base quarterly dividend they grow over time, but then they have these huge special dividends to basically just build up cash, then issue these special dividends. The economics, by the way, of this business are nuts. I cover it in the stock review video. The 5-year total return for this stock is 463%. Again, this was a steal during 2020. I wish I knew about it back then. And if you're wondering, this is the #1 energy stock I have on my list if we ever go in an oil and gas crash again. So those are my top 10 dividend stocks that I own in my personal long-term dividend growth stock portfolio. Let me know in the comments what you think about my account, if you own any of these stocks, and what you'd like to see a deeper dive on in the future. If you want to track your own portfolio, all of this is available at dividenddata.com. You can also get access to my stock research tool and the AI analysts that I showed throughout. And just as a reminder, I just gave access to the Dividend Investing Starter Pack for all members of dividenddata.com. That includes a full overview of my strategy and curated lists of high-quality investments. It also has a 90-minute video lecture of me going through my entire strategy and top stocks. Right now is the best time to join dividenddata.com. You can lock in 50% off forever. That's because of our summer sale, which is ending soon. There's a 30-day money-back guarantee, so no risk in trying it out. The link is in the description and pinned comment of the video. So if you're interested, click that link and get started today. With that said, thanks for watching, and I will see you in the next video.